How to avoid value traps and catch red flags when hunting down net stocks. Hey guys, how's it going? It's Charlie Marr here. Before we get started with the video, make sure to comment, like, subscribe, and share the video so we can keep going on with the next parts and, keep sharing a lot more of this. So just a quick recap. In part 1, we went over the terms and the formulas that you need to understand to approach with the net, to do the net valuations and approach with this approach. In part 2, we went over a live example of a stock that passes and that was trading below its net value. And then we did a part 2.1 of a live example of a stock that didn't qualify and it was not trading below its net value. In today's video, in part 3, we're going to go over a few red flags that you should avoid to, have a better a probability of the stock going your way and having a stronger portfolio or investment. So I am completely winging this. I hope I don't really miss anything out. I don't have a list with me. You guys know how I am with my videos. Okay, let's go ahead and get right into it. The very first thing you should be concerned about and worried about is diluting shares. So that could be a big mistake. So let's go over to the financials. Remember, as net hunters, we're going to be spending a lot of time in the balance sheet. So if we go here to the balance sheet and we scroll all the way down, we'll be able to see total shares outstanding. So here it is, total shares outstanding. And you want to avoid companies that are heavily diluting shareholders because it's going to decrease the value of your stock. And whatever number you came out with is going to drastically be decreased. And it'll change everything. So you want companies that are consistent. So if we look at this company, Charles & Colvard, we can see that it does dilute shareholders. I mean, we've had 19 million shares, 20, 21, 21.6, 21.7, 29 million, now 30 million. So this company, although it's not diluting like crazy, I mean, well, it's definitely up there. It definitely is diluting, but it's not killing their shareholders. There's definitely companies that do drastic amount of share dilution. We can look at a company like DSS. I mean, this is a stock that I knew was diluting shares and it completely destroyed its value. So we scroll down here to total shares outstanding. I mean, look at this insane dilution. Points from 0.4 to 0.5, 0.6 to 2.1, 2.7 to 7.9. They're cutting their values in half or more. You want to avoid stocks like this. So and let's go over an example of a stock that's very consistent. So here's Gigam. If we scroll down, you can see that their total shares outstanding are very consistent, if I recall. Yeah, look at this. 11.11, 11, 11, 11, 11, 11, 11, 11, and they diluted a little bit a long time ago. So a company like this, it's going to be very rare for them to dilute your share. So why is diluting shares important? Well, let's go over an example. Let's just pretend that we came out with a net working capital of a stock of 10 million. Okay, so that's the value that it came out with, right? Oh, it should have 10 million. And let's just say that they have 10 million in outstanding shares. Okay, so their outstanding shares is 10 million. So if we divide this would mean that it's it's just one share, $1 per share. Let me make sure the math here. I don't want to look stupid here. So 10 million net working capital, and then divide that by 10 million. It's a $1 per share, So that is the value. So let's just say that they go from 10 million to 14 million shares outstanding. Okay, so from 10 million to 14 million, they added 4 million more into the markets. So our value, our net working value or per share used to be $1 per share. But now, let's just say that, again, we're at 10 million for their net working capital. Now they have 14 million shares outstanding. So let's go ahead and divide by 14 million. Now it's worth 0.71. 0.71. Notice how that was a huge dilution and our value is a lot less. And remember, that doesn't even include the margin of safety. So if you had a margin of safety here and this stock was a buy at 0.66, well, now it's going to be even worse because now you have to get a third of value of this. So it really causes a lot of damage. So that is one thing you want to avoid. Stocks that are heavy diluting their shareholders because it'll deteriorate your value. Now, on the other hand, what we do like are stocks that are buying back shares. On the other hand, if they're buying back shares, so let's just go back to the example that they have 10 million in net working capital, and let's just say that they buy back shares, so now it's only 8 million. So now they only have 8 million shares outstanding. Well, now it's worth $1.25. So we've actually increased 25% from $1 to 1.25. So buying back shares is good. Diluting shareholders is bad. And if the company's consistent, I mean, it's just good. You know, it's not bad and it's not great. It's just there. So that's one major red flag. Another red flag I would say is avoid Chinese companies. Chinese companies tend to be very fraudulent, and you know they tend to cook books a lot. And as a net hunter, you're gonna find a lot of stocks that are Chinese, and they are always trading they're always like that. You know, these companies are always trading below net and stuff, but they never increase, and they're always cooking books. So a lot of the times, like, they'll be worth $1 and then they end up being worth like 10 cents or like negative value. So avoid Chinese stocks. That's one of the biggest things. It's very rare. Now, there can be some Chinese stocks that pass and are good buys, but it's very rare. I mean, 99.9% of them are going to be trash. So avoid Chinese stocks. I also highly recommend you avoid biotech and pharmaceuticals, because they're very capital intensive stocks. So a lot of these stocks, remember, we're looking at current asset value, right? Which involves cash. So they might have a lot of cash, but if their intent is to use that cash, it's going to completely change the value of that you came up with. If they have 10 million in cash and they use 9 million of it out of nowhere, well, now it just changed your number drastically. So that is one thing to be very careful with. So that's already 3 things, you know: avoid heavy dilution, avoid companies that are going to use their cash. You're gonna have to do some of your due diligence there. You know, you want to make sure you want to also, you know, the consistency of their cash. So you can see this one here is decreasing in cash, but it's decreasing at a very predictable rate. So like if you were to pre-calculate this, or like you have an idea more or less where their cash will be, but if it's all over the place, or if it's gone from 60 million to 1 million to 10 million to 8 million, it's just a big red flag. You know, you want to try to avoid that. So that's another thing. You know, are they going to use their cash? The other thing would be avoid, I don't know what number we are now. It was avoid heavy dilution, avoid Chinese stocks, and avoid pharmaceuticals, biotech, stocks that are very capital, that are going to intend to use their cash. So I guess the fourth one would be high cash burn. So if again, it's very similar, but it involves more like everything else within the company. You know, maybe they're losing a ton of money. Their net income is crazy bad, and it's eating away again their cash, and like even their inventory is decreasing like crazy. You know, so just the cash burn in general. You want to avoid companies that have a heavy cash burn. So that would be another one. What's another thing you can do to avoid major mistake? Sectors. There's going to be sectors that are always trading at very low multiples, or trading almost always below net values. So, you know, if a stock is always trading, let's just say a stock's net value is $1, and it's currently at 40 cents, but it's been around 40 and 50 cents for like 10 years now. What makes you believe that because you buy it now, it's automatically going to go back to $1? You know, so for whatever reason, that sector, that industry, or that company, because it can be a company itself, just is always trading below net. And you want to avoid those, because you're just going to waste time. You want to find those little imperfections in the market, those little wrinkles where a great company or a shitty company, you know, but it's a rare occasion that for a split second or a split moment compared to a long-term investor, it's trading below its net value, and then you'll be able to benefit off that bounce. The cigar butt method, you know, you get a free puff, a free pass. So those are a couple of things to avoid, some mistakes and things to avoid. What else would I say to avoid? So we talked about share dilution. Just the overall total assets going down, which I guess kind of goes back to the same thing. If you go here to the total current assets and it's decreasing heavily and it's not predictable, that's going to be a big mistake. You know, if it's going from 200 to 100 to 50 to 25, you don't know if it's going to go from 25 to 10 or 25 to 5 million. So that's going to be a big mistake. This kind of falls back into what I've been saying before. So you want to avoid those. I like predictable companies. Even this one that's decreasing, it's predictable. I can assume, I'm just going to kind of wing it and bullshit it here, but let's just say, more or less they could end up at 40 million next year, and then 38 million, and 35 million, and 32. It's dying. It's a dying company, but it's going to take some time, and you're not going to hold the stock for that long. Or maybe you can pre-calculate, I want to hold the stock for 3 years. Where would things look 3 years from now? You want to avoid companies that have a very crappy product. So again, remember when we're discounting items, it's subjective. The very standard number is to go 75 of account receivables and 50% of inventory. But if that inventory is, let's just say it's fruits. This is going to be a good example. Let's just say their inventory, if their product is fruits, this might not make sense, but just for the case of the video, you have to use common sense here. Then yes, maybe if they sell half their fruits for 50% off, they'll go from, let's just say they have $100 million worth of fruits, and then discounted that it's 50 million. But if they never sell them, they're going to spoil. So that's literally nothing. So you need to make sure what that company's inventory actually holds. And if it's also a rare product. So I always tell people, let's just say there's a syringe that's like an S shape. I know syringes are just a regular stick, but for the sake of this video, because it's meant for a particular medicine or liquid, I don't know what the heck I'm coming up with here. So it's like, well, could they if you liquidate the company, can you get rid of it? No, who the heck is going to want to buy it? Or if it's a failed product, who the heck is going to want to buy it? So why would you? So discounting at a 50% rate would be a terrible mistake at that point, because you wouldn't even get back of that. So that's where it becomes a little subjective. Maybe you end up discounting 90% or 75% of the inventory, or maybe you for a fact it wouldn't even go for. So it becomes very subjective. And the same thing goes for account receivables. You need to make sure where those account receivables are coming from. Are those companies reliable that owe them that money? That's where the due diligence comes in and the hard work. Let's just say a company has 100 million account receivables. Well, if that company that owes them that money goes bankrupt and they can no longer pay it, well, now you're screwed, because now you counted assets that are not even going to be in the books anymore for you. So all those little things are things that you need to try to avoid. And I'm sorry that I haven't really been showing anything. It's just me talking here. What else? If you're holding a dying company, you've heard me say it before, time is the enemy of a dying company. So over time, if that net working capital, that net value is decreasing, let's just say it's at $10 now, and then every year it loses $2. So it goes from 10 to 8 to 6 to 4. Well, it would be a terrible mistake holding a stock like that for a long time. You'll get fortunate enough if they get bought out before, if they merge, or they liquidate before then, which is a lot rare. But if they get bought out before then, you get your paycheck. But if you're holding a company like that forever, you buy it at 10, and it's not. It's a buy under 6, and it's been 3 years, and now it's worth $4. Well, now a dying company, time is the enemy. On the other hand, if that company is increasing from 10 to 12 to 14 to 16, then time is your friend. You want to hold companies like that. If you bought it at 10, if the net value is 10 and you bought it at 6, well, now it's worth 12 and 14 and 16. You can chase that net value decreasing, and maybe the company becomes overvalued and you have a huge winner. That's how you catch those big baggers. So I don't know. So all those are just things that you have to kind of just think of. To me, they're all common sense, but sometimes people don't catch them, or it might take you a couple years to catch them. Well, now you have them all here. So those are all little things that you want to avoid. I'm trying to think of anything else. Again, just think of the industry, the sector. Are they usually this cheap? What product they have, what company owes them their account receivables. These are all things that are super important, because those are value traps. That's why I don't believe in value traps. I don't believe in them because I can avoid them, because based on this criteria, this checklist that I gave you. Imagine finding a net stock, but they dilute shares like crazy, and then now you're stuck in a value trap, or their product is worthless, or like they have a lawsuit. So you want to be able to discount. Again, that's another thing you want to do. that goes more into the advanced process. Now that you understand and learn all this, you start to kind of add your own thing. Now, if you do all that and they have a lawsuit coming up in the next year or two, and let's just say that their net working capital is $10 million, but they owe $2 million in a lawsuit, or something's going to happen where they owe more money in the future, you need to deduct that ahead of time. Again, that could be a value trap. You go into a company, you think it's crazy, they have a crazy lawsuit, and the money's gone, or they used up all their money. I've had that happen with companies before. They have plenty of cash around and they use it all, and now it's not a net anymore. They're investing in another tech stock that might fail. Now I'm worried. So again, those are all mistakes you want to avoid. If you guys think of any that I might have missed, make sure to comment them below. Make sure to comment, like, share, and subscribe to this video. And if this video gets over 100 likes, I will release how to start scanning for these stocks, and then we'll go to advanced steps, because there's things you can do to make this even better. Anyways, I will see you guys on the next videos. Before I stop, remember the Value Investors Club. If you like all these net stocks and this type of mentality and this type of investing and value investing in general, come join the Investors Club. We are a group of leading of investors. We love talking about all this. If you can't get enough, that chat, the lounge, is just going to have everyone talking about stocks and picks like this, and we're all hunting these stocks. We're all looking for value. If you miss anything, someone else might help you with it. Everyone's sharing their watch list, their picks, what they're valuing that you might not have seen or missed. Maybe they're sharing their scanners. We have a bot, so if you hate doing the math, all you have to do is type in the ticker, and you'll get the net value of a stock. Anyways, so that is Charlie Marr right now. That's Charlie, M-A-R-R, 2 R's. You'll probably see the link somewhere in the description, comments, or if you find me on social media. Yeah, I'll see you guys on the next video. Make sure to like and subscribe.